Today, we're going to tackle something that honestly affects every single one of us: financial risk. We're going to cut right through all the jargon and give you a simple but really powerful way to think about it. The goal? To help you make smarter financial decisions and protect the things that matter most. Okay, let's just dive right in with a question. What do you think is the single biggest financial risk you're facing right now? Just take a second. What comes to mind? Is it the stock market tanking? Losing your job? Something else? Whatever you just thought of, there's a pretty good chance that the really dangerous risks are the ones hiding in plain sight. They're the ones we just don't think about or we push to the back of our minds right up until it's too late. And today, we're going to learn how to spot them. So to understand risk, we first got to know what we're actually up against. Let's use a little story. Think of a peril as the actual bad thing that happens. That's the monster. A fire, a car crash, a lawsuit. The hazard, now that's a little different. It's the condition that makes it more likely for the monster to show up. It's the dark forest where the monster lives. Like faulty wiring in your house or texting while you're driving. Okay, so if perils are the monsters and hazards are the forests they hide in, how do we figure out which ones we should actually worry about? How do we size them up? Well, it turns out there's a really simple two-part way to do this. The first factor is frequency. It's exactly what it sounds like. How often does the bad thing happen? Some things, like, say, spilling coffee on your shirt, that happens a lot. Other things, like your entire house burning to the ground, are, thankfully, very, very rare. And the second factor is severity. This is all about the damage, the financial hit. How much does it cost? Losing a $20 umbrella is an annoyance, right? But getting hit with a major lawsuit, that can be completely financially catastrophic. Now, here's where it gets really cool. We can combine those two factors, frequency and severity, into something called the risk matrix. And this right here is the main idea. See, if something happens a lot but doesn't cost much, those are just annoyances. You pay for them yourself. If it's rare and low damage, again, you just handle it. Now, if something is both high frequency and high damage, well, you should probably just avoid that activity altogether. But it's that last box, the catastrophes, that's the one we really, really need to talk about. Because here's the thing. 3 of these quadrants are totally manageable. But one of them, that one, has the power to financially destroy you and your family in one shot. This is the one that most people get wrong. And this brings us to the golden rule of risk management. You should always insure the things that happen very rarely but cause catastrophic damage. These are the house fires, the major disabilities, the unexpected deaths. They are unlikely, which is exactly what makes the insurance affordable. But if they do happen, insurance is the only thing that can save you from absolute financial ruin. Still think high severity is just some abstract idea? Let's make it real. Picture this. A delivery driver slips on your icy front steps, injures their hand, and can never work as a surgeon again. They sue you for all their lost future income. A lawsuit like that could easily be for $6 million. That's a high severity risk. It doesn't just take what you have now, it takes everything you will ever earn. So, what's the game plan? What can you actually do about these risks? Well, you've got 3 main defense strategies. First, you can try to control it. Make it less likely or less damaging, like putting salt on those icy steps. Second, you can transfer it, and that means making someone else pay. Or third, you can retain it, which is just a fancy way of saying you've decided to pay for it yourself. Let's really focus on that middle one, risk transfer. This is the absolute genius behind how insurance works. You pay a small, known amount of money, your premium, to an insurance company. And in exchange, they agree to take on the risk of a huge, totally unknown loss. You're literally transferring that financial monster from your shoulders onto theirs. Okay, let's take this golden rule and apply it to one of the biggest, most difficult risks a family can face: the premature death of someone who brings in an income. This is a classic low-frequency, high-severity event. It's exactly what insurance was designed for. So when you look at life insurance, there are basically 2 main types, and there's a great way to think about them. Term insurance is like renting a car. It's cheaper, it covers you for a specific period of time, like 20 or 30 years, and it's just pure protection. If the worst happens during that rental period, your family is protected. Permanent insurance, on the other hand, is like buying a car. It costs more, it's designed to cover you for your whole life, and it builds up a cash value over time. Now, think back to our golden rule. For that catastrophic risk of dying young when you've got a mortgage and kids, term insurance is often the most efficient tool. You're renting protection for the exact years you need it most, perfectly transferring that massive high-severity risk. So, what are the big takeaways here? First, just remember that risk isn't the bad thing itself, it's the uncertainty around it. Second, that simple risk matrix, that's your new best friend for sizing up any threat. Third, and this is the most important one, the golden rule. Always, always transfer the risks that can financially destroy you. Using this framework will empower you to make smarter and, frankly, much less anxious decisions about money. And that brings us to one last question. Now that you have this framework, now that you know the rule, let me ask you again, what's your biggest low-frequency, high-severity risk that you haven't transferred yet? Just thinking about that question, that's the first step toward real financial security.